Getting a mortgage when you're self-employed in the UK can feel like an impossible task. Banks love stability, and if you don't have a 9-to-5 job with pay slips, they make you jump through hoops just to prove you can afford a loan. Here's the truth. More than 20% of the UK workforce is self-employed, yet many people struggle to secure a mortgage simply because they don't know how to present their finances in the right way. But don't worry, in this video I'm breaking down exactly how to get a mortgage when you're self-employed. This isn't just generic advice you'll find anywhere. I'll share insider tips that can really make or break your approval chances. If you want more content like this on property and finance, do me a favour, hit that subscribe button and let's get into it. How lenders view self-employed applicants. The first thing to understand is how lenders see self-employed applicants. When you're employed, it's simple. Your salary, payslips, and contract give banks confidence that you'll keep getting paid. This makes you a lower risk borrower in their eyes. But if you're self-employed, your income is unpredictable. So lenders tend to take a much deeper look at your finances to assess risk and consistency before approving your mortgage. Here's what they typically look for. Your trading history. Most lenders want to see at least 2 years of accounts to see how your business is performing. However, some lenders would accept just 1 year, which I'll discuss in a bit. Your average earnings. Lenders usually take the last 2 or 3 years' profits and average them out to determine your income. Your tax returns. You'll need SA 302 forms and tax year overviews from HMRC to verify your declared income. Company structure. If you run a limited company, lenders will look at both your salary and dividends. Some will even consider retained profits. Consistency. If your income varies a lot from year to year, lenders may use your lowest earning year to calculate how much you can borrow. This could significantly impact your mortgage offer. But don't panic, there are ways to strengthen your mortgage application, and we'll get into those next. Documents you need to apply. One of the biggest mistakes self-employed people make is applying for a mortgage without the right paperwork. Lenders are strict about documentation, so getting everything sorted before you apply will make the process much smoother and faster. Here's what you'll need. SA 302 forms and tax year overviews. These documents show how much income you've declared to HMRC. You can download them from your government gateway account. Business accounts. Lenders prefer accounts that have been prepared by a chartered accountant, and this proves income stability. Bank statements. Usually, lenders ask for the last 3 to 6 months worth of statements to check cash flow and spending habits. Proof of deposit. If you're putting down a deposit, lenders want to see where the money is coming from, whether it's savings or a gift. ID and proof of address. These are standard requirements for any mortgage application. And here's a top tip. If your income is complex, work with a specialist mortgage broker who deals with self-employed applicants every day. They know which lenders are most flexible and can match you with the best deal. How much can you borrow? Lenders typically offer between 4 to 5 times your annual income as a mortgage loan. However, the way they calculate this depends on how your business is set up. For sole traders and partnerships, lenders will look at your net profit after expenses to determine how much you can borrow. For limited company directors, most lenders assess your salary and dividends. Some may also consider retained profits, but not all. For contractors, if you work on a contract basis, lenders might calculate your income based on your daily rate. A common formula is day rate times 5 days times 48 weeks. For example, if you're a contractor earning £250 per day, some lenders might assess your income as 250 times 5 times 48 equals 60,000 annual income. This means you could potentially borrow between 240 to 300,000. However, if your income fluctuates, lenders may base their calculations on your lowest earning year rather than an average. That's why maintaining consistent earnings can help increase your borrowing power. How to improve your mortgage approval odds. If you want to improve your chances of getting a mortgage as a self-employed person, follow these steps. Keep your accounts in order. Hire a qualified accountant to ensure your accounts are professionally prepared. Reduce business expenses temporarily. The fewer expenses you deduct, the higher your taxable income appears, which increases your borrowing potential. Increase your deposit. The bigger the deposit, the more comfortable lenders feel about approving your mortgage. Check your credit score. A strong credit score improves your approval chances. Check yours on Experian or Equifax and fix any issues. Use a specialist mortgage broker. They know which lenders work best with self-employed applicants and can match you with the right deal. And here's what you should avoid. Don't hide income to pay less tax. Declaring a low income to save on tax can backfire when applying for a mortgage. Don't change business structures just before applying. Switching from a sole trader to a limited company too soon can reset your trading history, making it harder to get approval. Don't take out new debt before applying. Large credit card balances or loans can lower how much you're eligible to borrow. By following these steps, you'll stand out as a low-risk borrower and improve your chances of approval. So there you have it, the step-by-step guide to getting a mortgage when you're self-employed in the UK. It might be a bit more challenging than if you had a 9 to 5, but with the right preparation, it's absolutely possible. If you found this video useful, do me a favour, hit that subscribe button. Catch you on the next one.